everyone. Hope everyone can hear me okay. Look, I want to welcome everyone to yet another SPAC conference. I don't know how many years we've had this for, but it feels like a while, or a certain percentage of my life. And we've had, this room has gone through waves. Sometimes it's been full, and sometimes it's not been full. But it looks like we're back to being full again, and that's a great thing to see. I'm happy to kick it off again this year. I'm thankful that we're getting a brief respite of rain. As a Westchester resident, it's felt like a monsoon month, so hopefully, we could hold off from the rain just another 24 hours. I want to thank Deal Flow, the sponsors that were just mentioned, the Westchester Country Club, making this happen every year. It's a great event for the SPAC industry, and it's become a staple for the SPAC industry. And me and my firm at Loeb has been very proud to be a part of it since the very beginning. Look, I'll try to make my remarks really, really brief. I feel like I'm cutting into the middle of cocktails and dinners and want to get you back to that and the ability to market within the SPAC ecosystem. But I do want to highlight some of the basic things that are happening in the SPAC world, some of the basic trends that we've seen over the past year since we've spoken last year. And as I always do every year is just provide you with some just general thoughts and observations of the SPAC market as we see living in this on a day-to-day basis. I'm going to turn this over to a PowerPoint so you can follow on here. A couple words about us. Okay. Market-leading advisor. We're an international law firm. We, been with the SPAC product from the very beginning, over 25 years of history. Always at the top of league tables, number one in terms of deSPAC legal counsel, and up there on the SPAC IPO legal counsel. Definitely worked with some of the first structures, the first $10 units, the first Cayman organized SPACs, the first extensions, all those innovations. We were, proud to be a part of that development, along with some of the other people here who have been active in the SPAC product for the last 20 years. So what we're going to talk about a little bit is an overview of the current SPAC market, the IPO process, the deSPAC process, talk about some regulatory updates, evolutions over the past year, and where that lands us into today's opportunity. And again, just talking about how this makes sense for people. All right, so let's look at some statistics. I don't know if you guys can see it, but we all know 2021 was a monster year for SPACs, the 613 SPACs. We never seen anything like that before. We may never see anything like that again. That number went down to 86 in 22, down to 23 was sort of like a low spot of 31. But look, the important thing is to look at what's going on this year. You can see that, and by the way, this doesn't cover the full end of June, right? So we're not even at a half a year. And if you look at the number of SPAC IPOs that were done so far this year, not even getting through a half year mark, we're at 57 SPAC IPOs. That is almost the total number of SPAC IPOs we had last year of 57. I think we'll get to the 57 or eclipse it by the end of the month, just in half a year or 6 months. The other very interesting statistic here is how SPAC IPOs, what they represent as a percentage of total U.S. IPOs. There's only been 73 U.S. IPOs. In other words, 19 non-SPAC IPOs representing 74% of the total IPO market. That's a significant number. If we go back to the 21 and 22 years, we don't see, that much of a percentage as we're seeing this year. That's a very, very telling statistic. People talk about the fact that is it a crowded market? As of June 1 this year, 132 SPACs with over $28 billion are seeking a business combination. That's a fair conversation. Is it a crowded market? We only have 9 non-SPAC IPOs. The market for companies seeking to go public is quite a bit larger. There's a discussion to be had whether we really are crowded, maybe a little bit, maybe not. Other developments in terms of stats, redemption rates stayed high in 2024. So you've got 94% average redemption rates for deSPACs closed in 24, 93.9 last year. So the redemptions are still high. The PIPE market hasn't been that strong has been weak, frankly, in 24. There's been only $600 million of PIPE financing raised. 500 came out of a Bitcoin, deal, a crypto deal. So that didn't leave much for a very successful PIPE market in 24. There was even more raised in the PIPE market in 23. Here's some good news. If you look at the price performance of deSPACs this year, the average deSPAC stock performance is up to $3.48 as of this month in June, and that's up from $2.40. So we're seeing some appreciation in terms of like how these deals are trading this year. We're also starting to see a decoupling of the $10 price, leading to different valuation analysis going into the deSPACs. I'm going to talk about that towards the end of the presentation. That's an important issue and a point. What we've also seen is that on IPOs, deals are starting to move slowly away from warrants and into rights as a response to the fact that, they haven't been trading, not a lot of deals trade above the 1150 strike price on warrants. So the market is seeing value coming from rights more so than warrants. It's not a black or white thing, but it's a trend that we've seen. So now let's get into more of a little bit of a legal regulatory update. The good news is we have a new SEC commissioner, Paul Atkins. Gary Gensler is done. We all know that Gary Gensler was no fan of ours. I remember being up here 2022 talking about his proposals and rule changes and all that, and everybody thought, he's coming after us. And in some ways, I guess he was. But, the SEC on Friday, they had a spokesman that spoke out to the media and said, and this spokesman person said, as the chairman, Paul Atkins, has said, we're getting to a place to our roots of promoting rather than stifling innovation. The markets innovate, and the SEC should not be in the business of telling them to stand still. So we haven't necessarily seen a drastic move from the SEC, but the message being sent from the SEC is, let's promote innovation, not stand in the way. We've seen movement, climate risk deals, disclosures, and so forth. But what we're also seeing movement is with crypto deals. We've seen, new trades. We've seen SPACs get into crypto. Also from the same release, the SEC just on Friday said that I'm trying to read my handwriting here. They have moved to set regulations around digital assets and integrate cryptocurrencies into the financial systems, including through the creation of a crypto task force. So what we're seeing is an opening of that space under Gensler. Doing a crypto deal in the SPAC world in particular was a massive problem. But it looks like the SEC is starting to address different types of crypto, and we're starting to see them get into our deals more and more and more. In terms of the SEC and the SPAC industry, we're now familiar with the new disclosure requirements because of the proposals and then resulting enacting rules. We're not seeing those warrant or other accounting issues that much anymore. The NASDAQ has passed a rule, 5815, effective January 25, which basically, in delistings decisions, they've restricted what they're analyzing. They're not necessarily looking at ongoing compliance. They're looking to see if decisions that were already made were done properly. And another development on NASDAQ, which we're going to talk about pretty soon, is the 3-year rule. They're basically looking at the fact that SPACs have a life of 3 years. Then after that, you've got, if you're organized properly with the SPAC on top of your structure, you have 6 months to relist. You'll then be considered a SPAC and not a shell. If not, you're subject to the seasoned rules. I'll talk about that a little bit more. Look, the NASDAQ transaction process continues to lag. They're like backed up on deals. There has been a slowdown there. The round lot stockholder issue is a focus of the review. It's a very significant focus of the review. And that has become something to really watch out for in these deSPAC transactions. making the shareholder round lot test to be able to list on NASDAQ. Some practical aspects, challenges in the market right now. Look, what we saw in the last year or two, we saw SPAC sponsors who tried to get a deal done and weren't able to get a deal done. They tried to sell or assign their promote or their sponsor investment to a new buyer. We're not seeing that much anymore. That trade has sort of really slowed down. New sponsors aren't looking for old structures and certainly not willing to take on liabilities, obligations, or whatever happened in the old SPAC. So that is leading new sponsors into new IPOs. We're seeing since last summer, since a little bit less than a year ago, we're seeing syndicate pre-IPO rounds. This allows sponsors to spread the risk, get some of the risk investment from other investors. Although because of the really warm reception that sponsors have had to this idea, and many have jumped in, it's obviously become a little bit more difficult for new sponsors that have stepped up and want to take advantage of it. Another development we've seen over the last year is essentially the death of the Delaware SPAC. We don't see SPACs being done in Delaware anymore. And that's subject reason because of the excise tax. Every time you had redemptions, you have to owe a 1% tax on those redemptions. You have a $100 million SPAC, it's a $1 million tax liability. And so the way around that is to form the SPAC in Cayman. And so basically every SPAC you see filed these days is a Cayman SPAC. Extensions. We're seeing less of those, right? The last year, maybe a year before, we talked a lot about extensions, SPACs needing more time to find their target and so forth. I think what we're seeing there is that a lot of those older SPACs have really just played themselves out one way or the other, and we're up to a new cycle of just new issuances and new SPACs and starting up a new clock again. For the ones that are extending, we're seeing a lot of terms all over the place. A lot less money are being put up by teams looking to extend their SPACs. They're just putting up whatever money they want, and they're seeing what happens, and they're seeing if investors are going along with it. 40 Act issues, we talked in the year or two past about the SEC having concerns about SPACs becoming a 40 Act if they go on for a certain period of time. That chatter has pretty much gone quiet. Not a lot of noise on the 40 Act. We saw a lot of that a couple years ago. We are continuing to see equity lines being offered for SPACs, convertible debt as a way of financing when pipes can't otherwise be procured. Non-redemptions agreements, traditionals and structured, still exist all over the place to try to keep funds in the trust at least through the business combination and to a certain point. And then, of course, there's the practical challenges that deSPACs face. They do. It's the question is, will there be enough cash at closing to take care of all the obligations in light of the fact of a 94-95% redemption rate in a light pipe market? The question is can the deal survive cash requirements at closing? And then, of course, I talked about the round lot issue and the NASDAQ standards, and SPACs looking to struggle or finding ways to be able to meet the NASDAQ requirements so they can get listed after the deSPAC. On extensions, because of redemptions on extensions and so forth, and the reduction of shareholder numbers, public float, market value of securities, you are seeing SPACs get delisting notices or notices of noncompliance from NASDAQ. That's a reality that we're dealing with. There is a concept of converting sponsor shares into public shares to preserve listing, to get more float. We see that as a device being used more and more often, and that's nothing new. That we've been doing that for a few years already. Always conversations about NASDAQ versus NYSE. Each of them have their own place. I think NASDAQ has been a little bit more proactive in dealing with some of these issues and giving up a little bit more clarity. Sometimes we like it, sometimes we don't. Most of the time we don't, but at least we know where we are. NYSE is a little bit more, waiting to see what happens. So now the other issue is the 3-year limit to complete a business combination. NASDAQ has clearly said that, listen, 3 years and that's it. We're going to suspend the SPAC. You do, if you're able to relist in 6 months afterwards, having the right structure, that's fine. You won't fall into shell status. Shell status puts you into a seasoned issuer rule, which means that you've got to wait for a year or wait for the SPAC to get seasoned to reapply. There are other structures that allow, in terms of moving the top entities so that you could be exempt from this whole thing altogether. That's a little bit more detailed, but those are the basic concepts there. Now let's talk about recycling of capital. This is a main driver for the SPAC IPO market that we're seeing right now, or the resurgence of it. The expiration rates are higher. We saw 56 liquidations in 2024. Sounds like that's a lot, but however, $14.2 billion were returned to investors. That is being used to reinvest into new IPOs. And those high redemption rates, although they seem high with the 94, 95%, again, they are also a significant source of recycled capital. That's about $14.7 billion that were redeemed in 24. When you add the two together, that's about another $29 billion that will probably go back into SPACs from fixed income investors. All of this has led to this new wave that we're starting to see right now, and what I touched at the beginning in terms of just the sheer number of new IPOs. Again, the syndicated or the sponsors trying to seek a syndicated round before a pre-IPO sponsor round has picked up. Sponsors are trying to invest as little, if they can, as $500,000 as risk capital, with the rest being syndicated out. That's become more difficult. Investors have pushed back, looking for a little bit more commitment from sponsors. Certainly, if the sponsor has been successful in prior deSPACs, that will help. But that has helped the new wave. Also, what has happened is that sponsor investors, as well as sponsors themselves, continue to negotiate to average down their cost basis of their positions. We're not talking about $10 cost basis of investments anymore like we used to on the traditional pipes. They're bringing that down significantly and creating that arb, or creating that potential of return. In some cases, what we've seen, because of all these syndicated shares, we're seeing larger promotes. Not always, not all the time, maybe not even a majority of the time. But some of the time we're seeing larger promotes to accommodate the syndicate investors to be able to share, promote with them. The fact that higher interest rates haven't really been reduced significantly and have sort of stayed where they are. There's always pressure to move down rates, hasn't really happened. And what that has allowed us to do is to not contribute as much funds, to prop up the trust fund percentage. I'm going to talk a little bit about performance measurements. And up to now, we've compared that to the $10 IPO price. That's something I'm going to talk about here at the end. But it's something that I think the market is starting to look at, whether that's the appropriate measurement. One thing that's a significant development in the SPAC world is really the transformation of the underwriters. The underwriting fee structure has completely changed. A lot of underwriters are trying to adapt. Some new underwriters have come in to deal with not only lower or more flexible upfront underwriter fees to reduce risk capital investment, but also on the deferred fees, because a lot of these deferred fees became, sort of crippling as it got down to the end, or to the deSPAC. So that has definitely been a transformational development for the banks or for the underwriters in this business. And so now I'm really just with that, I'm just going to wrap up and just give you some, some basic thoughts about where I think things are based on all of these developments. Many ask me, and you always get to ask these questions: are SPACs back, or SPACs back? Like every year, other than 21, they ask, are SPACs back? And I think it does continue, and it continues for a few reasons. There's money to be made by the sponsors; they're coming in at a low enough price. There's money to be made by sponsor investors; they're coming in at a low enough price. It's always been a great product for fixed income investors. They're getting a pretty good yield for owning essentially treasuries through the SPAC vehicle. even though the business has changed or transformed, it's always been a business, like it or not, for the underwriters. Again, it's different, but it continues. And most importantly, it remains a certain vehicle for companies to go public. Now, it's true that many of the old issues of SPACs will persist, right? We have come up with version after version, improvement over the structure, but we're not going to resolve all the prior issues with prior versions of the SPAC. There still will be issues. There will be sponsors who, frankly, are not fit to be sponsors. There are targets who, frankly, should not be going public, but that's what they want to do. There are deals that are irresponsibly priced. We don't have an underwriter necessarily clearing the market, so some of these deals are priced at levels where they shouldn't be, or structured as they shouldn't be, and that results in underperformance of the stock price and stock performance. And some of these deals, because they can't get financing they can't get money from the trust because of high redemption rates or because of a light pipe market, walk into financings that are punitive and cause ultimate underperformance in the stock price. And frankly, to be honest, there's a bunch of new advisors that have stepped into the business that they really don't have the experience, and that's I look at it as like a kid playing with fire. This is all true. Okay, those are all the issues, but the SPAC does serve an important purpose, and we shouldn't lose sight of this no matter what the issues are. Growth companies are consistently underserved by the capital markets, always. The international markets aren't doing the job. Those companies can't get what they want out of international markets practically anywhere. And where they want to do is they want to come here. They want to come to the U.S. capital markets. That's their goal. And the SPAC is really their only certain way of doing it. What I mentioned before, earlier on, is that this year, for example, there were only 19 non-SPAC IPOs. That is no way going to serve the international community and the growth companies across the world. So they will need something to fill that void, and the SPAC does that, and it's a very, very important function. The problem that we have to deal with as a SPAC industry is the misconception of pricing and performance. Because what happens is you look at how a deSPAC does in comparison to the $10 price, and that's a mistake. The $10 represent the cash value in the vehicle, and as we know, 94% of that on average gets redeemed. So that $10 isn't the price to measure it against, and I think that we got to think about a different measurement in terms of how to do it. And because of that, I think SPACs unfairly get a bad rep because of sort of the decrease of where they trade compared to that $10 price, not just necessarily looking at that company's value and how they trade irrespective of the $10. And then when you add to the fact that everything is publicly available, it exacerbates that perception. Not so the case with VC and private equity. When those deals don't work out, they're private, nobody knows about it. So if we, look, it's been a long road to get here. For those of us that have been in this business for 25 years, there's always work to be done. We continue to have work to be done because we're going to need to work at creating an industry where we have pricing discipline, even though you don't have an underwriter to clear pricing on a deSPAC. We're going to need to find ways to exercise pricing discipline and the appropriate metrics for these deals to be actually analyzed, properly. But, with all that, it still remains viable. We're still at, 70% of all IPOs. This is a real industry. It serves a real purpose. I want to wish you all a really good conference over the next 24 hours. There's a lot of people here to speak to. I look forward to speaking to many of you, and enjoy yourself. Take care.